In this last video, we will focus on the different ways companies have to remunerate their shareholders, or to return cash to them. Additionally, we will investigate whether payout policies affect the market value of a company. Studying this topic, Modigliani and Miller developed the so-called payout irrelevance theory. We will see what that means in a minute. Let's begin. There are only two ways companies can remunerate their shareholders by distributing cash, either by issuing dividends or by buying back stocks. When companies announce a dividend policy, they promise their equity investors regular payments over a defined period of time. Dividends can be announced directly as per share amount or through a payout ratio, which is the percentage of earnings to be paid out. For example, a company might announce a dividend per share of $10 for the next 3 years. Alternatively, the same company could announce that it will pay out 30% of its net income for the next 3 years as dividends. Dividends are said to be sticky since once they are announced in a certain year, investors expect them to continue in subsequent years as well. If a company stops paying out dividends, that is usually assumed to be a sign of bad financial health by investors. Sometimes then, companies do not want to commit to a dividend policy. Nonetheless, if they still want to remunerate shareholders, they could announce a stock buyback instead. The mechanics is simple. The company announces it will repurchase, let's say, $10 million of its stock in a certain period. Dividends and stock buybacks are not mutually exclusive. Companies can do both at the same time. Take Kellogg, the breakfast cereal company. As you can see from the example, it bought back shares worth $240 million in 2021 and $300 million in 2022. At the same time, it paid dividends of $788 million in 2021 and $797 million in 2022. Generally speaking, when a company announces a dividend increase, it is a good news for investors. In fact, investors know that managers are reluctant to reduce dividends and will not increase them unless they are confident that the payment can be maintained. Therefore, the announcement of a dividend increase signals managers' confidence in future profits. For this reason, higher dividends usually prompt a rise in stock prices, whereas dividend cuts result in prices falling, although this is not what the Modigliani and Miller theory predicts, as we will see in a moment. On the other hand, the announcement of a stock buyback does not entail a commitment to continually do so in later years. Therefore, the information content of a repurchase announcement is less strongly felt by investors than the announcement of a dividend increase. Anyway, investors may still upload buybacks if they worry that managers would otherwise invest excess cash in unprofitable projects. Since announcement of dividends and buybacks can convey information about management's confidence in the future performance of a company, it is only natural to ask whether the timing and the amount of a payout policy affect the market value of a company. In other words, can companies optimize their payout policy in order to maximize their market value? Modigliani and Miller answers these questions by developing the so-called payout irrelevance theory. As the name suggests, according to Modigliani and Miller, the payout policy is value irrelevant in a world without taxes, transactions costs, and other market frictions. Modigliani and Miller argued in analyzing a payout policy, investors should hold fixed firms' assets, investments, and borrowings. Suppose firm A has 1 million shares outstanding and the following balance sheet at market values. To keep this thing simple, assume that firm A has no debt, all of its fixed assets are already paid for, no leases. Its working capital includes enough cash to finance its operations. Firm A's market cap is 11 million euros, 1 million shares times 11 euro per share. If it now pays out its entire cash as dividends, the market cap, all else being equal, will drop to 10 million, since there is 1 million less of assets, namely cash. Since the number of shares stays the same, the market cap adjustment will occur via the share price, which will drop, after the dividend payments, to 10 euro. To sum it up, a dividend of 1 euro per share was paid out, thus shareholders' wealth, including dividends, is now 10 euro of shares plus 1 euro of dividend equal to 11 euro, with same amount before the dividend payment. What happens if firm A decides to buy back shares rather than pay out dividends? Firm A uses 1 million euro of surplus cash to buy back 90,909 shares at 11 euro each. That is 1 million divided by 11. In the end, shareholders' wealth is the same regardless of dividends or buybacks. If firm A pays a cash dividend, shareholders' wealth is 10 euro shares plus 1 euro dividend, so 11 euro. If firm A buy back stocks, there is no cash dividend, but each share is still worth 11 euro. Investors hold less shares now, but they got their fair market value when they sold them back to firm A, so that their wealth is still 11 euro. As we should know by now, Modigliani and Miller propositions work if we set some assumptions. In this case, we assume that there are no taxes and no transactions costs. Therefore, investors are completely indifferent between dividends and stock buybacks. In real life, though, this is not always the case. Usually, dividend income and capital gains are taxed differently. Moreover, personal taxes on dividends have to be paid immediately, while taxes on capital gains can be deferred until the securities are sold and the gains realized. Finally, there might be transaction costs to consider when selling a security. Given these considerations, stockholders do have preferences regarding payout policies. Some investors prefer to receive dividends, while others may prefer stock buybacks. The clustering of stockholders in companies with payout policies that match investor preferences is so-called the clientele effect. On average, stockholders who prefer dividends are investors that need steady cash flows to live on. For example, retired people usually invest in companies that remunerate them through steady dividends, through which to pay for daily needs. In principle, these cash flows could be replicated by investors on their own, selling a small fraction of their investments from time to time. However, it is way simpler and cheaper for a company to send, let's say, a quarterly check to their shareholders via dividend than for them to sell a part of their holdings from time to time. In other words, regular dividends relieve shareholders from transaction costs. Institutional investors, who are tax-exempt and need steady cash flows to fund their investment, these also prefer dividends. On the other hand, stockholders might prefer stock buybacks, if dividends are taxed more than capital gains net of transaction cost. In this case, rational investors should prefer stock buyback as a payout policy, if they do not need regular stream of dividends to pay for their needs. Once again, Modigliani and Miller proposition tells us that dividend policy is irrelevant based on some assumptions, but in reality, if we relax these assumptions, actually there are preferences for dividends or stock buybacks amongst investors.